Welcome to AM Best Audio.
Welcome to this AM Best briefing, State of the Captive Insurance Market. I'm Lee McDonald. The formation and use of existing captive insurance companies provides a viable enterprise risk management alternative for companies that understand their own unique risks. When feasible, companies would prefer to get coverage from the commercial market, but where coverage appears overpriced for a company's own perceived risk, captives continue to be a logical alternative. Captive use continues to expand in the persistently hard market through formations, increases in retentions, and inclusion of new lines of coverage. Over the next hour, a panel of AM Best analysts, along with captive insurance experts, will explore the latest trends in captive insurance and what's driving the results. We'll meet that panel in just a moment. We may mention the subject of financial strength ratings. A full explanation of AM Best ratings is available online at ambest.com. And finally, the opinions expressed by our non-AM Best panelists are theirs and theirs alone, and do not necessarily reflect the opinions of AM Best. And if you have a question for our panel, please use the Q&A feature next to the video player, and we'll do our best to recognize it during this discussion. Now let's meet our panel. I'd like to welcome in Joe Mather. Joe is Insurance Director at Phillips 66. Joe, welcome.
Good afternoon.
Thank you. Also, we have Steve McElhaney. He's Senior Vice President and Global Director of Reinsurance at Artex Risk Solutions. Welcome, Steve.
Glad to be here. Thanks, Lee.
And here in the studio with me, we have Dan Techlaw. He's Director at AM Best. And Dan, welcome.
Thanks, Lee.
Okay, and we're gonna start off with you. Let's start with what AM Best is saying about captives. What is AM Best saying about the underwriting performance of captives?
Sure. So we just published our annual report, and we find they continue to outperform the commercial casualty composite both annually and for the long term. And that seems to really validate the reason they were formed and the viability of the segment. So I'm going to give you some data that shows we look at a captive insurance composite that includes single parent captives, groups, RRGs, and it's a casualty insurance composite or captive insurance composite. And you see it includes the SPC, single parent captives, and the RRGs. And the performance is really barbelled with the single parent captives having low combined ratios, generally because they've got low expenses, and the RRGs generally performing close to the market, but it's a good alternative to the commercial market for companies in a similar line of business that want to efficiently get their insurance for smaller companies or entities or members. We look at all these companies under what's called our alternative risk transfer criteria, and we're in the process of updating that as well. So when we look at the captive insurance company composite, this is a busy slide, and I'm not going to point to a lot of things through here, but I want you to note on the left-hand side, the written premium continues to go up as the hard market persists. You see it's gone up since 19. The hard market really started in 2018, I think. And in 2022, significant growth as I think members decided and figured out that the market was going to persist further in property for the most part. And they also were coming out of the pandemic. So that drove a 27% increase in written premium for our companies in that composite. Now, in looking at each of these individually, the single parent captive composite, and mostly I just want to refer you to, well, you see generally on the left side, the investment yields have improved since 2022 when the rates started to increase. But in the last two lines, in the furthest three columns, you see that the underwriting ratios for the single parents are significantly better than the for the commercial casualty composite. You'll notice in 2023, though, We had about a 20-point increase in the loss ratio for single parent captives as they took more property losses. But still, it's well within the bounds and the volatility that we see on the or expect within the performance of them. And I've got one more to show you, I think, which was the RRGs, and a similar story here to what I had described at first. But they have seen some improvement in their loss ratio, looking at the three columns on the right in 2023, and then the 5-year averages. They're pretty much right around 97 compared to the 5-year average for the commercial casualty composite of 97.5. So they would not probably be able to do that on their own in a lot of ways. So that's been very beneficial for them. And then the last item that I want to show is those results have led to, you see in the lower right, $6.4 billion in savings for these entities that could have gone to the commercial market, but instead they were able to better manage their own risks and grow their surplus to cover future risks, as well as distribute another $2 billion in dividends.
This might be a good time to mention that AM Best has just released a report on rated captives.
Yes.
I would imagine a lot of this information and more. I know it's very detailed.
It is, and those slides were pulled straight from there, and I didn't want to inundate you with data, but that's why I tried to point you to certain sections of it.
So it is posted today, and always ahead of the Vermont conference, well ahead of the conference, and it's always a report that draws a lot of interest. And your team is involved in that as well, of course. Yep. You briefly mentioned risk retention groups. Is there anything you wanted to say about the underwriting performance of risk retention groups?
So just that, like I said, back here on this, they're seeing a little bit of improvement in. We're not seeing a lot more formations, except maybe in commercial auto liability. We're seeing some improvement in the loss ratios because they understand their risks and do a bit of information sharing to try to do some loss mitigation and prevention ahead of claims management. You can see they had a very good year in expense ratio in 2022, but it's kind of reverted back to norms, and they perform right with the market. So that's pretty much what I would say about RRGs. Okay, and what can you tell us about growth in captive domiciles? Yeah, so generally, these are the top 10 with 11, I guess, with 100 or more licensed captives within each of their domiciles. We haven't seen very much movement, except for like a place or two among maybe 2 or 3 of these. Generally, we were seeing 5 to 10 probably % growth in each of them, really. What these do not show are like cells and series captives. These are kind of licensed and approved entities, I believe. But in 2020, there are about 3,000 of these, and now there are 3,365 as a net number, because they also go into dormancy or runoff as well. Okay. And Steve McElhaney, I'd like to bring you into the conversation here. Let's talk about single-parent captives. What are you seeing there?
Well, a lot of activity. So we're seeing during the hard market, as Dan referenced, a lot of activity in terms of formations of captives, inquiries. We're also seeing some repurposing of existing single-parent captives. And what I mean by that, it might be a captive that was originally set up to fund deductibles, or maybe take in one line of insurance like workers' comp, but looking to repurpose it for property access. So it's, I think in terms of sheer formations, all the domiciles will bear that out. They're seeing a lot of new formations coming in, and just a lot of activity that's many ways driven by the hard market, and property has definitely been where my team has seen the most activity. We're working to really take captives to help them access facultative reinsurance, so it becomes a risk transfer solution. And there's a variety of reasons what are the catalysts behind that. Beyond the hard market, some carriers have retrenched a bit in terms of their appetites, and so that's been a common reason where an account has just been non-renewed traditionally, and so it goes and forms a captive through us, and we access reinsurance and go from there. But it's definitely, I think the whole marketplace is now much more aware of the captive tool, and they're looking to provide that solution. Brokers are to their clients, and very different than say 10 years ago. So I think when the hard market levels out, which is there's signs that it is already, I think the interest level will remain.
Okay, well, thank you. And we're going to come back to that in a few minutes. But first,
Sure.
Joe Mather, welcome again. And
Thank you.
you're in the energy sector. And what are you seeing in that market in relation to larger energy risks?
Yeah, so really from a downstream energy sector perspective, which is where our company sits, it's really continues to be a tale of two markets from our perspective. So our sector, really the largest insurance programs are property and excess casualty. So we spend a lot of time working on those. And really on the property side, after several years of rate increases, really from 2018, as Dan said, we started to see the property market level off last year. Not the case in all sectors, but that was kind of our experience. And then for this year, we're hearing positive outlooks from the broking community that we may even see rate reductions in our sector through the remainder of this year. So it's kind of a good news story, I guess, from downstream energy. We do have smaller joint venture companies that we work with, and that is not the case. Some of the smaller ones are seeing a significant hardening just starting this year. So there's a little bit of a lag in some sectors versus our direct one, but certainly they're seeing that now. And again, to Steve's point, I think we're going to see a continued interest in captives as those other companies catch up and want to have alternative solutions. So, and then on the excess casualty side of things, that really continues to be extremely challenged for large capacity buyers like us and our industry generally. So we're still seeing companies scaling back capacity or exiting from our market sector completely. So there are new markets coming in. The opportunists seeing that the rates are good and there's that they're not hindered by some of the historical losses that the markets have seen, and that's helped to offset it in to some extent. But we're not really seeing a healthy excess casualty market yet, I would say.
Okay, thank you. And as I mentioned, we're going to come back to Steve in 1 second. Just want to mention to everybody, we encourage your comments and questions. And on the player there's a tool, and please feel free to submit one. Steve, you mentioned a minute ago that you saw kind of a growing range of reasons and risks for people to either form or expand a captive. What are the risks that work best in a captive? And also the other side, what are the risks that probably don't work well in a captive?
Sure. So, traditionally captives have been an excellent tool for like workers' comp, property, excess casualty, as Joe mentioned, commercial auto, transportation, those sorts of lines of business. And so increasingly, with my clients, I'm advising them. You can always put a deductible and fund that within a captive. So perhaps it might be initially formed for, say, property, but there are retentions along across the entire program, and there's no reason that those retentions cannot be funded in a captive, and we often recommend that. But I guess where areas where it's more challenging use for a captive would be cyber and D&O, and I'll go into that a little bit. Cyber can certainly put large retentions into a captive for cyber and attach higher. But I think one of the key benefits you get from cyber in the traditional marketplace is incident response and all that goes into post events that you'd have to unbundle that and put it into a captive, which can be a little more challenging. And then with D&O, the so-called Side A coverage is always a difficult proposition for a captive. I think some states and jurisdictions actually prohibit that. And then the issues around, the inherent conflict of a company responding through a captive owned vehicle on behalf of directors. So typically side A would be kept out of a captive unless it's a sell solution. But yeah, generally we see a lot of application for captives, and I think that's the common thread, that maybe in year one we form one for a property need, and then years 2 and 3 we start looking at medical stop loss. That's a big theme we're active in right now. Putting other retentions in, and a lot of it's going to be really dictated by the pricing dynamics. So, for some of the lines of business, like low limit traditional GL, that can be fairly competitive. To Joe's point, definitely the excess is very challenged. But so many times we find that it's just some of those are better kept outside the captive. It's just more cost efficient. But the concept of building retentions and funding those is really gaining, and that helps the momentum of the captive over time.
Okay. Joe, I'm going to come to you in a second with a question back about energy, but I just want to mention, I mentioned that we have comments and questions that are encouraged, and someone responded to that. And Steve, perhaps you'd like to start with this question, which is, how often does a captive change carriers or intermediary? What do you see in terms of the change among those two constituencies?
It's fairly uncommon, to be honest. It's quite an effort to set up a captive and put in a risk transfer program, and it tends to be fairly persistent business over time. I think I guess the point on the carrier, someone might be looking from the standpoint of a front issuing carrier, and there can be change there. It can be challenging with collateral and getting that released. From my view, and doing it, it's fairly uncommon, to be honest with you, unless there's an event like a merger or something where there's two companies come together with two captives. Perhaps that might be the catalyst. And on the front end side, those tend to be fairly long-term relationships. So really, in the efforts of forming a captive, we put a lot of effort to really align with the best service providers for the long term. And it is quite an effort to get the captive launched. And it's pretty uncommon, I think, in my view, to see that change with the providers.
Dan, I saw you nodding your head, and you get to meet a lot of captives. Is it generally with the same intermediaries and the same risk partners?
No, I agree with what Steve was saying. I mean, they offer limits. Captives typically offer limits to their parent, and then they may top it with reinsurance, which may have already been established with the parent. And the only changes that I really see that are significant are if they're growing a tower or something like that, or if they need to plug holes in a tower to kind of respond to pricing for efficiency. And I think those are the main things that I kind of see for changes.
Okay. And Joe Mather, just want to return to you. Next month I'll have been at Best 28 years, and the first captives I ever counted here were energy captives. I know you're just a child and you wouldn't know the whole history there, but what can you tell us about the long-term development of how energy companies utilize captives? Has that changed?
Yes, so you're right. Captives are a very familiar concept in our industry. Big risks, big retentions. So really, we've had significant benefits from that as an industry for a number of years. But the soft market conditions went on and on and on a lot longer, I think, than anyone expected. And really, it was the hard market that really showed what an opportunity we had to showcase even more the purpose and benefits of having the captives, especially if you've had them for a while, built up some capital and some strength in there. So as Dan mentioned, a lot of companies issue limits to their parent through the captive and then buy reinsurance. That's very much the model that we use here. So we've got big reinsurance markets behind us, and when the market turned, that was a challenge for us. But we as I said, thankfully we're ready to go, as the majority of the large energy companies were the very early signs of the hard market back in kind of 2018, 2019. So I think we recognized the market needed to correct itself. It continued years of losses and underpricing were not sustainable. So we understood that we're partners with the commercial insurance market. So we wanted to give them time to kind of get where they needed to go. But also we wanted to be recognized for our risk profile, our operational excellence, and the fact we didn't have any losses. So that's where it starts to kind of feel like you may not be getting treated as an individual risk versus the whole market and being bundled in. So really, the captives gave us and our industry peers an alternative option, just to replace lost or overpriced capacity. And also, we were seeing onerous terms coming in, certain markets trying to push agendas and things. So we wanted to check that where's the market going to settle, and if we weren't comfortable, we could use the captive just to fill those layers as things developed over time. So I think that was the general theme of how the energy companies used the captives and how it changed over the last few years. And later we're going to talk about some of the more innovative things that we're using them for as well. But that's probably the main difference.
Yeah, I look forward to that part of the discussion. Steve, I want to jump back to you because a second questioner did a nice follow-up to the first question I asked you, which is about whether they changed intermediaries and carriers. But in that same regard, are you seeing new entrants into the captive space among carriers or intermediaries? Are you seeing a lot of fresh faces there?
Yeah, for sure. So, and particularly with the issuing carriers, the fronting carriers, a number have come in the last couple of years that I think have been well received into the marketplace. We're starting to transact business with a few of them right away, and so that's been good to see. Frankly, 5 to 8 years ago, it was a very limited number of fronting carriers. So that's certainly the case, and I think that's good for the market. Provide more options, different risk appetites. So that's very much the case. In terms of new carriers, less so. I think that's probably one of the takeaways of this hard market. We haven't seen a lot of new company startups come out of it, that we did see in the other periods like Katrina and so forth, 9/11. It tends to be more capitals going into existing platforms. But definitely the risk appetite is picked up, and in programs we've renewed this year, we've been able to bring on some new carrier partners, which is good, and that's much more orderly market. But I do think in terms of the issuing carriers and fronts, there are some new names, some new players, and it's very good in my view for the market.
Actually, the other side of the coin would be, do you see many exits among that cohorts, or do they tend to stick?
Yeah, they tend to stick for very much so. So I think it's been, the new entrants coming in. They're all, I've talked to all of them. They have basically different appetites, different sectors they're going after. So it's not a commodity approach where they're going to drive down the overall pricing, but spots where there's been some gaps. So you got global carriers that have always been part of that world, and you have the pure fronts and captives. Both can work, but oftentimes I deal more with the pure fronts, and so how they structure their approach becomes everything to how the deal works.
Mm-hmm. And Dan, anything to add to that in terms of, are you seeing many new intermediaries or carriers, or pretty much the standard lineup?
I think companies like RGs pretty much have relationships that they build, and they use their reinsurers to kind of help them understand their risks better. So they're longer term partners. So, mm-hmm. So I would say they're not really changing and exiting really.
There's other markets that would love to say that, I think, but it's who knows. And Joe, let's move to the question you mentioned very briefly. Actually, I'd like to hear a lot of detail. New and innovative areas that you're seeing that captives or your own organization or ones you're familiar with. What are those what you would think of as new and innovative areas?
Yeah, so outside of the traditional property and casualty lines, I think there's always something that triggers innovation and new thinking. And like the hard market triggered some of the things we were doing on that side. The next big thing really was the pandemic. That had a profound effect on the industry, and companies generally were having a difficult time. So one of the things that we did, and a lot of companies did, was bring their employee medical programs into the captives. So again, worked if you had a captive ready to go. It was kind of a short window of time. But there was significant benefits to companies through the CARES Act that was released that year as a way of helping recognise some of the impacts on income. So that trend has continued. Yeah, Steve mentioned that it continues to be an area of interest. Medical costs are suffering from inflation and just general increases. So it is one of the largest costs a lot of companies are burdened with, and are looking for different ways to manage that cost. So again, captive cells, things like that can be very, very useful solution in that space generally. And then another hot topic is other employee benefits in captives. So every conference you go to, there'll be panels on that and talking about what people can and can't do. Again, this can be more challenging. You generally need Department of Labor approval or an exemption to write those or self-insure them in any way through captives. So for example, if you wanted to write life insurance policies, critical illness, those kind of things, there's a lot of benefit in that again, and it could reduce costs for the company. But we were working on it for around 5 years before we got that exemption. So it's not a quick fix solution, but again, for some companies, it's definitely worth considering and looking at as a longer term commitment. So those are two areas. Steve mentioned D&O. The market hardened significantly on the D&O side, especially more for the independent E&P energy companies. They were under strain financially, so the market started pulling capacity and coverage from them, and so that almost as a distressed position led them to look at D&O in their captive side A only. So we did look at that, but our rates were not under the same pressure, and in the round we didn't feel it was a good solution for us. Again, would agree with Steve on the cyber side. It's kind of difficult with those products that come with a lot of support services to really just pull it out and put it in a captive. You're kind of missing some of those additional elements. So yeah, we're always looking at new areas. There's a lot of things to consider, but those are probably the ones we've heard most about recently.
Steve, I wanted to follow up sort of along the same line, innovative, what you might call new and unique risks going into captives. And
Sure.
there's headline risks that probably more people write about than actually experience, but they're going to be big, like obviously cyber's there, AI, all kinds of biotech, things like that. Are you seeing that in the captive sector, or is it too early, or is it not the right fit?
I think it's a bit early. I do think it's probably a fit for sure. That's the great thing about captives. They're very innovative, and there's ways to manuscript coverage, find support behind it. In a super hard market, that's a little tougher to achieve. But I think you're spot on. Those are some of the emerging themes. Life sciences, definitely a lot of conversations there. But even the more traditional companies, I do a lot in chemicals, power gen, supply chain, and they all look towards coverage enhancements. And the captive through a manuscript policy can provide that, and get reinsurance support behind it that you may not get traditionally. And that's kind of a magic benefit of a captive. So there's a lot of that discussion going on, and but yeah, definitely, when you look at the world of emerging casualty risk, there's I'm sure at various board levels, a lot of conversation about, what's the proper retention, should we try to achieve risk transfer around some of these things that are still evolving, the mass torts of the future, if you will, so it's, and that's really what's great about a captive. It's a very innovative tool that I've, over the years, been able to work with clients to put some innovative solutions in there. Like one case, we put an appeal bond in a captive, and we're able um, to do that to save them money. And they prevailed in the appeal, and it was premium savings and things of that nature.
And Dan, sort of following up with the same idea, in your conversations with captives, are you seeing a lot of what you might call, I don't know, frontier risks or things that 5 years ago really weren't even talked about?
Well, as Joe and Steve have both mentioned, cyber, of course, the group medical, we'll talk about that a little bit later. And then we have a couple of group captives that are aligned along in the same industry, education and whatnot, that face issues around social inflation and things like that for different kind of claims, where their interests might be aligned, but they might not have the same risk appetite for certain things. So they'll cover either some of their GL and commercial auto that we've seen, but they might also not agree on what they want to put in for the rest of the captive. So even though they've got other lines and considerations, they might not want to keep that in their captive, but might form like a risk purchasing group to kind of go separately for those type of things, for a different appetite for some or all of them.
Okay. Steve, I'd like to come back to you, and actually I'd like to combine a couple questions here. One we had prepared to ask, and another one that a viewer sent in, and which is, could you just walk us through a typical process of establishing a captive insurance company? And as part of that process, how are they typically capitalized, and what's the extent of that capitalization that might be typical?
So yeah, sure, happy to do it. So basically, there's a couple avenues that such a company can go through. Either a segregated sale, perhaps some of it might fit into a group captive, but assuming a single payer captive is the path they go, it's basically a process we go through. So initially, we'll have what we call a discovery call, a deep dive with the client or prospect about, does the captive really make sense in terms of loss experience, size, and so forth. And assuming we go through that, then we will engage into a feasibility study, which is essentially a very comprehensive business plan that's going to be used to license the captive with the state of domicile. And then after that, basically we look, it's an unbundled solution. So we're basically looking at unbundling the claims through a TPA, the CPA perhaps, the actuaries involved, the reinsurance broker, the captive manager. So it's a bit different for most clients where they're used to a bundled solution with one carrier and everything goes in and claims get paid on the back end. So that's all about a lot of vetting, and the clients get very involved in that, talking to different options. And assuming we come out of the feasibility, let's form and look at a license, we'll do that. And most typically, I'm involved with my team of simultaneously doing risk transfer. So, for example, we form a captive at 1/1/25. We take them out of the traditional market, and at 1/1/25 have a reinsurance-backed program go live. So it's the time. Certainly 3 months would be the lower level. I mean, there's a lot of pieces to do there, and but we have done them sooner. But sometimes with the client, it's a bit some apprehension. It's a very new way of looking at risk. And really keep getting them very involved in the process every step of the way, and then just knowing when the captive does go live, they have service providers doing the heavy lifting, and they're coming in more from an oversight role, and just a board of directors role, help place the reinsurance, that sort of thing. So it's it's quite a process, and it's each one's different. But generally, it's I think a very good, thorough process. It brings the right candidates to the table, and they go forward. And sometimes out of a feasibility study, some may say, well, it's not quite the benefit we were thinking. We'll keep it in mind for next time. But that's fine, right? They will have answered the question for their boards by doing a formal study.
Thank you. Dan, just to follow up on that a little bit. Are you seeing any changes in how captives or trends in how captives are being capitalized?
See different ways that companies are doing things and different alternatives. So, and I'll say that it probably depends on the type of captive you're speaking to about. With the single parent captives that have large corporate parents or owners, they may have different options than a risk retention group, for example. And when we've seen single parent captives capitalize straight with cash, of course. Often they use a loan back arrangement, which is a demand note to the parent, and allows them to keep capital credit in a captive while the parent or the full enterprise doesn't lose benefit of the liquidity. We've seen companies use hard assets that are dead on. I'm going to call them dead on the parent balance sheet. They're fully depreciated, but they've got physical value that regulators have allowed them to put into captives as long as the parent's got liquidity to buy them back out. We've seen a little bit of that. And then on the risk retention group side, we've seen obviously surplus notes, letters of credit, and I guess the one thing that I would say is typically with risk retention groups, and we find that those generally to be smaller amounts, and they're trying to support growth for our management teams that might have a good plan to build a risk retention group, but they're not as well capitalized, but they've got small retention, so they've got a chance to kind of grow into that. I think one of the things that we've seen in the hard market, we've gotten a lot of inquiries from newly formed single parent captives that bring in a fair amount of capital, but they've got higher limits set. So it's a high retention to surplus ratio, which is in our world, that's not good, because then one stress or full limit loss, and you're kind of back to square one. So I think that's one of the challenges. You're talking about the methods, and I'm just talking about a little bit about the sizing of what we see with a couple of these different alternatives.
Okay, thank you. Joe Mather, you're an interesting organization that I believe you have several captives in several domiciles. What's the thinking there, and why would you put a particular captive in a particular domicile? What's the strategy?
So we started with 2 captives originally, one in Vermont and one in the Cayman Islands, and really the thinking behind that was as straightforward as domestic risk and international risk. So that worked well for us to have the 2 operating separately for those programs. And then in 2014, as with a lot of US states, there was captive legislation rolled out in Texas where we're headquartered, and that trend has continued across the nation. So just about every state now you look at has got some kind of captive legislation. So that was when we set up a third company here in Texas and really the benefit of that is around self-procurement tax. It's kind of a straightforward frictional cost for companies if you're based headquartered in Texas and you buy an insurance program, for example, from your Vermont captive. Those premiums are taxed at 4.85% self-procurement tax. So for big energy companies here in Texas, that can be a significant cost. So simply by establishing a local captive in state and writing our risks for the Texas-based assets through there, the tax rate drops to 0.5% for the Texas premiums, and then that's capped at $200,000 per year. So it's really kind of a no-brainer to add that third one to our family, and that works well for us as it does for a lot of companies with big programs. If they're using maybe a different domicile state versus their home state, so that's kind of the thinking there. But again, years ago, it used to be a relatively straightforward decision of the kind of top main domiciles and where you might want to play golf, I guess, was in the matrix. But now it's a little bit more of a minefield for people to think through all the options and what works best. What I would prioritize over everything is the experience of the domicile and the regulator. So we get a lot of knowledge and input from the Vermont regulator and the Cayman Islands regulator. They have an open door. They're very business friendly, and as we've evolved, they've also given us ideas as to how to do that in the most effective way. So there's a lot of value in basing yourself in those locations as well.
Thank you. And I'm sure that all those domiciles have great golf courses, so it's even harder to choose, right?
They do.
Steve, I wanted to follow up with you on essentially the same question. A client walks in the door, they're going to form a captive, you've got a clean sheet of paper. How does the domicile discussion go?
Sure. So, to Joe's point, there's many quality domiciles. I think in the U.S. maybe 30 plus at this point. And so, first of all, you have the offshore versus onshore dynamic. And most of my team, we work on onshore formations. In terms of where a lot of times it's going to be client directed. So I always want to present to our client different options, have them actually get on a Zoom call with 2 or 3 of the regulators, and where's the chemistry? What do you feel most comfortable? And certainly, when you look at Vermont, for example, it's preeminent, and all the service providers are really centrally based there. And to Joe's point, it's very, first and foremost, you want a regulator that's going to be responsive, because with a captive, you sometimes have special requests coming in late in the year before balance sheet date, and you want those things turned around very quickly. And so that I tend personally to do a lot in Vermont, but there's some excellent ones all throughout the United States. And sometimes with the client, it's driven on by location. So they may be in the West and might be more inclined to go with Montana or Utah or Hawaii or something of that nature. And sometimes the self-procurement tax is a driver too. You can line up with the domicile where that works. But it's very client directed, and it's really they all do a good job, really, and they're well served. And but I think offshore we tend to work there more with multinational type captives, where that dynamic works. But I have put a captive down in Bermuda and one in Cayman in the last couple of years as well.
Okay, thank you. And we're getting a lot of excellent questions here, and I'd like to kind of do a little round robin and clean up our list here. First question I'll throw you is social inflation. Now, AM Best has written about this in a couple of reports, obviously a big issue in casualty lines. Is it an issue in the captive sector? Dan?
Yes.
Okay.
I'll say that risk retention groups run into this a fair amount in their claims, of course, with claims management and claims resolution, especially in the lines of commercial auto and MPL, of course. Some in higher education where you think you have like a limits case or a certain level case, and then all of a sudden it gets into the courts because an arbitration or settlement discussion goes poorly, and then you're just stuck with these high verdicts. So I think those are the big lines that we've seen them in in the risk retention groups more than the single parent captive, unless you look at like maybe ESG or something like that, and even that would be D&O down the line. But I don't see any of that right now.
Right. And Steve, any particular type of captives particularly sensitive to social inflation?
Yeah, definitely. I have clients that are buying high limits, like 250 million and above, and at that higher level, that's where it gets very challenging. The markets have either gone down where there's more intensive premiums or pulled out, and so that's been a struggle sometimes to fill those upper limits. I think honestly, it's a real phenomenon. It's you can't turn on TV and not see solicitations for litigation, right? Any baseball game you're going to watch, you're going to see 5 such commercials, and you got litigation financing going on now, through hedge funds and others. So it's just the sheer volume of litigation, and it's becoming a 50-state phenomenon too with these high verdict awards. So I've had a lot of discussions with reinsurers on this, and I get it. I mean, if they lose money in a 50 million X of 200 million layer, how many years will it take a premiums to ever pay that back? So they tend to be pulling down, and so that's really kind of a disconnect. The buyers want those limits desperately. They're becoming very expensive or hard to pull together, and I don't see it changing. I really don't.
Mm-hmm.
Yeah, I would just add to that from some of the conversations we've had with companies considering captives. They may look at their claims experience for the last 5-10 years and they think, oh, we'll make a killing if we have a captive. And what we're having to say to them is that even the actuaries are struggling to forecast some of these trends and outcomes. So you can't necessarily rely on history as a good indication of the exposure you might be taking on in the kind of auto GL layers. So it's something that you need to be more cautious about, I think, in terms of what it's going to look like in the next 5 to 10 years.
Thank you. And just a more specific question, perhaps I'll start with you again, Dan. Are captives always backed by reinsurance? And then the same question is whether the captive needs support. Is the parent always committed to that support?
Well, that's the big question. One of the big questions for us. So
I thought it would be.
they're not always backed by reinsurance, but the parent could be insured separately. So they could be basically like a working layer that, or a deductible reimbursement kind of layer that they offer the parent. Essentially, I mean, that we see some of these companies, and we're seeing a lot I'll give examples of a couple of like home builders where they'll not fully reinsure. They'll offer limit to the parent, and losses beyond the limit go back to the parent. So then we have two different pieces that we look at when we look at ratings, but just viability would be, can the parent pay the losses that they would expect to have as a gross type of loss? And the second is, if it's supposed to be a perpetual captive like we see and we expect to see in our ratings, do they have ability and willingness to pay that? So we have a concept in our ratings called lift and drag that we apply sometimes to companies that may have high limits, not have as much capital as we want in there, but the parent could show the ability to support it should it ever need it. There's some that don't show it or don't show a need, so we don't always apply the lift and drag, though.
Thank you. And Steve, the last question we'll address from the viewers, another good one, of course. Parametric covers. That's becoming more common in the general risk environment. Is it present in captives?
Yeah, very much so. It's in many ways, a captive's the perfect vehicle for a parametric. You can fine tune it to a very narrow sublimited cat risk and buy just what you need. The proceeds would be paid back into the captive, and it's this very efficient vehicle. So we're finding a lot of conversations on those cat exposed renewals involve parametric. Sometimes it's a tougher conversation with clients, because they perceive the so-called basis risk between the true loss and what they might get paid through a parametric vehicle. But that's become very narrowed now. There's more markets involved, and so I see that's going to expand for some of these peak zone secondary perils, like wildfire, and a way to if you have a high sublimit. Or rather a low sublimit in a wind event in Texas or Louisiana, you can supplement that through parametric. And I think the final point is what the captive owners like is that parametric pays back losses very quickly. Like within 72 hours, you're getting initial proceeds, whereas traditional reinsurance can take quite a while to go through the settlement pipeline.
Okay, great. Thank you. We're coming toward the end, so we want to get in some quick general questions here, and then we'll sum up and Dan Teklov, will start with you, which is basically, what's your outlook for captive profitability and for this year, and I guess looking forward?
Yeah, I think that it's going to be more of the same. I mean, generally with risk retention groups, we'll probably see them perform about the same as the industry, just as they have. We'll see a little bit of volatility here and there, and some higher loss ratios, maybe if they have some premium pressure. But generally, that's kind of one of their fundamental things they need to do is get actuarially type needed premium in order to provide the coverage to their members. And with regard to the single parent captives, I think the premiums are going to continue to grow. They're going to be used as much or more than they have been before, and then and priced appropriately. And I'm we'll see a little bit of volatility if there's some spike losses here and there. But unless there's something systemic, then I don't see any reason that anything will change. Surplus will continue to grow, and dividends will continue to go back to parents, I believe.
Well, thank you. And Steve, let's looking. Where do you see the captive industry headed? And what I'm particularly interested from you is, what are some of the things that probably are on the horizon that most people aren't aware of?
Well, in terms of the industry itself, I see continued growth. It's say 20 years ago was pretty narrow group of Fortune 500 companies that were largely in captives, and at least from a U.S. perspective, and now it's a wide swath of companies, middle market, Russell 2000, privately held, and so that penetration is just going to continue. In terms of industry types, is pretty wide open. The ones that have an interest in it, so I see continued penetration there. Actually, we're active right now in Canada, working on some captives up there, and I see a lot of growth there. And same in Mexico, actually, with nearshoring and some wonderful companies down there. They're looking at the captive vehicle, and that wasn't the case. There's only been a handful done in Mexico, so I see that continuing. I think it's probably the final point, which it's been an industry 20 years ago that was kind of a cottage industry of captives, and now it's a main pillar of the general insurance and reinsurance industry. And I guess I would also see existing captives being repurposed, and more of that to come, of using it in a broader way than maybe they have historically. So it's, I think, very positive for the industry. I think there's a lot of potential there. And, I guess, as the market changes, I don't see a real movement away. I think, the captives are here to stay. I think what I do see is insureds of all sizes now are asking their brokers, does a captive work for us? So it's kind of, the inquiries are coming from the ground up into the industry that is very different. And so I'm encouraged, and I guess, like I said earlier, they're very innovative. So for emerging risk, that's a real good way for a company to put some cover in place and start to fund it, and so I see as an incubator, it's going to continue.
That's great, and thank you. You've been very informative. And Joe Mather, I'd like to give you the last word. You're the risk practitioner here. What perspective would you share with people who are in a similar position to yours, where they're operating captives, and those particularly who are examining to say maybe it's for them? What would you tell them?
Yes, I agree with Steve. It's an exciting time to look at captives, and if you already have an established company, maybe repurposing it or looking at some of those innovative areas can really add value to your organization. And sometimes that means connecting with your HR folks or different parts of the business, ESG, finding out what's going on and partnering with them on some of those. It's exciting, and there's a lot of other benefits you can bring to your organization. And then if you're looking at a captive, which a lot of people are, as I said, some of our joint venture partners are looking at it. What Steve said was music to my ears. You have to look at the data. It might not give you the answer you want to see, but you should listen to that. Maybe wait until it's the right time, and don't just be led by frustration that the market is targeting you in some way. It's just correcting itself largely. It's nothing personal, but some people are frustrated and making decisions not always based on the facts. So I would encourage a solid basis of data to make those decisions and move forward as an essential thing. So.
Well, thank you very much. And Joe Mather, thank you. Excellent presentation. And Steve McElhaney, we really appreciate it. Dan Techlaw, another good job. I'm Lee McDonald. We're going to be closing this down. I will remind you that AM Best has posted its annual report on the rated captives. I got a good look at it this morning, and I will tell you it's more detailed than previous reports. It's really got a lot of information in it.
Great.
And Dan, you'll be up at Vermont?
Sure will.
And Steve, I know you'll be there, right?
Yes, sir. Yep.
Joe, are you attending or?
Yeah, we'll all be there.
Well, there you are, the great captive rendezvous up in Vermont there. And thank you very much. We'll have a transcript posted with this playback, and watch for the report. Thank you very much. Lee McDonald for AM Best TV.
Looking to get the full attention of the insurance industry? We have the platforms that will do just that. Whether it be AM Best TV, AM Best Audio, Best Review Magazine, or Best Day. Find out more by calling AM Best Advertising Sales at 908-439-2200, extension 5399, and have a great day.